Hello there everyone and welcome to today's vlog. Today I'd like to talk about investments, specifically tax efficient investments. And the topic for today is on venture capital trusts or VCTs. This is part of a series of vlogs on tax efficient investments. So what is a VCT? A VCT is an investment trust which is listed on the London stock market, and taxpayers invest, they buy shares in that venture capital trust. The trust itself then uses the money to invest in a whole series of smaller companies. So you are minimizing the investment risk by the fact that actually the money that you put in is being divided amongst several firms. Now, because that is deemed to be generally riskier than, say, investing in the FTSE 100, the government say, okay, we'll give you some tax breaks for doing so to encourage people to invest in these VCTs. There are significant income tax and capital gains tax breaks. The first one is the income tax break for the investment itself. So HMRC say that you can have a 30% credit against your tax bill on the amounts that you've invested. So if you've invested £10,000 into one of these venture capital trusts, you let HMRC know that on your tax return, and they will say, okay, take 30% of that, which is £3,000 in this case, and knock that off your tax bill. So if you are self-employed or a partner, or you're paying your income tax twice a year, it will be reduced by the fact that you've made this venture capital trust investment of £3,000. If you are a higher rate taxpayer and you are an employee, you still can claim back the £3,000 by completing a tax return. So in addition to the upfront income tax relief, there will be dividends generally paid out from the VCT. Now these dividends are not taxable. So tax-free dividends, because normally if you held shares in a, say, FTSE 100 company, you would have to pay tax on the dividends. But if it's a venture capital trust, there is no income tax to pay on the dividend income that you receive. One of the conditions of the trusts is that you have to have the money invested for 5 years. If you pull the money out before that, HMRC will claw back the upfront income tax relief. So assume you're going to have this for 5 years. So tax-free dividends for the 5 years, and then if you sell, after that point, you sell your shares, hopefully you've made a capital gain. So let's say in this example, the 10,000 turned into 15,000. Well, HMRC say that that capital gain of £5,000 is exempt from capital gains tax. So remember, a regular investment in stocks and shares, you would have to pay capital gains tax on the gain. But with these venture capital trust shares, there is no capital gains. So upfront income tax relief, no income tax on the dividends for at least 5 years, and then no capital gains tax at the back end when you come to sell the investments. And as I said earlier on, the investment risk is deemed to be higher by virtue of the fact that these businesses tend to be a lot smaller than, say, FTSE companies. However, that risk is then minimized by the fact that the venture capital trust will invest in several of these businesses. So your money will not just be in one particular company, it will be in a whole range of companies. Now, just some examples of quite well-known companies that at some point, as they were getting going, relied on VCT investments. Companies such as Zoopla, Secret Escapes, Love Film, at some point they had a round of funding which was through VCTs, so higher rate taxpayers coming together to invest in those businesses. So to find out more about venture capital trusts, do contact me and I can tell you more about how to invest in these products and also more detail on the tax breaks.